Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Apple is well known as a technology leader, but it's also incredibly smart when it comes to managing its finances. Behind the scenes, Apple has been running one of the biggest and most effective share buyback programs ever seen. This approach uses clever financial strategies to increase shareholder value by repurchasing its own shares, which can boost earnings per share and overall market confidence. What we'll explore is the math and mechanics behind how Apple turns its financial decisions into a powerful tool, shaping the company's value beyond just its products. The visual here reflects growth with the rising arrow and stacked coins, symbolizing increasing value and financial strength driven by these buyback activities. Apple's rise is often linked to its iconic products like the iPhone and services like the App Store. But there's another key factor that isn't as obvious: the steady reduction in shares outstanding. This might sound technical, but it directly impacts what investors focus on: the earnings per share, or EPS. Apple has not only grown its profits, but has also been buying back its own shares aggressively, shrinking the number of shares available in the market. Over the past decade, Apple bought back around $704 billion worth of stock, which is more than the market value of many public companies. This massive buyback program means fewer shares are spread among investors, so each share represents a larger claim on Apple's earnings. In other words, Apple isn't just selling products and services, it's also boosting value for shareholders by quietly increasing their ownership stake in the company's profits. Earnings per share, or EPS, is a simple calculation. It's net income divided by the number of shares outstanding. Companies can increase EPS by either growing their net income through better products, pricing, margins, or new markets, or by reducing the number of shares available, which is done by buying back stock. Apple has done both, but buybacks are unique because they boost EPS instantly without needing new products or market growth. For example, if a company earns £10 million with 10 million shares, its EPS is £1. If it buys back 20% of its shares, reducing the total to 8 million, and profits stay the same, the EPS rises to £1.25. That's a 25% increase in EPS without any increase in profit. This is why buybacks are so powerful. They mechanically improve this key metric. Investors often value stocks by multiplying EPS by a P/E ratio. So when EPS goes up, the stock price usually rises too, even if the market's multiple stays constant or shrinks a bit. This explains why buybacks matter so much in stock valuation. What really sets Apple apart in its buyback approach is how consistent and large-scale it is, combined with a sophisticated way of funding these buybacks and clear communication about its role in capital returns. Unlike many companies that may do buybacks occasionally, Apple authorizes and executes them year after year, accumulating to what amounts to hundreds of billions of dollars over a decade, $704 billion by 2025, which is historically exceptional and not just a single large capital decision. This is more than just returning cash to shareholders. It's a strategy to concentrate ownership by reducing the number of shares outstanding. Another important detail is how Apple funds these buybacks. It's not just from leftover cash. Apple strategically issues bonds when market conditions are favorable, using that debt alongside cash flow to buy shares. This flexibility lets Apple manage its capital structure thoughtfully, taking into account tax benefits, interest rates, and maintaining financial flexibility. Finally, the way Apple executes these buybacks is mostly through open market repurchases, meaning it buys shares steadily in the marketplace over time rather than large one-time purchases. This ongoing scalable method allows Apple to be flexible and consistent, reinforcing buybacks as a core part of its financial strategy rather than a one-off event. When a business earns more cash than it can reinvest profitably, buybacks become one of the key ways to allocate capital thoughtfully. Instead of only focusing on reinvesting in growth or paying dividends, buybacks offer flexibility since they can be paused when needed. unlike dividends, which investors typically expect to be steady. For companies that are stable, generate consistent cash, and are trading below what they're really worth, buybacks act like an investment in their own business, creating value without altering operations. Additionally, if a company compensates employees with equity, issuing new shares each year can dilute ownership, and buybacks help offset this by reducing the share count, preserving value for long-term shareholders. This strategic use of buybacks reflects a deeper capital management approach beyond just the headline figures. Before executing buybacks, it's important to confirm certain conditions. The company should be generating reliable free cash flow from its core business and have excess capital beyond what's needed for realistic growth investments. Ideally, the stock should be at least fairly valued, if not undervalued, and the balance sheet must be strong enough to handle the cash outflow or any additional leverage. A major warning sign is borrowing heavily to repurchase shares when the business itself is in decline. Next, clearly define the objective behind the buyback. Objectives can vary, such as efficiently returning capital to shareholders, improving per share metrics like earnings per share or free cash flow per share, offsetting dilution from stock-based compensation, or signaling confidence in the company's intrinsic value. It's common for companies to say buybacks are just about returning capital when the real intent is to boost earnings per share, but the market usually sees through that. Being honest and clear about why you're doing buybacks helps maintain credibility and make better strategic decisions. When deciding how to execute a buyback, most companies start with open market repurchases because they offer flexibility and allow for gradual pacing. Tender offers provide a quicker way to repurchase shares, often at a premium, which can speed up the process but may carry a higher cost. Accelerated share repurchases, or ASRs, work through banks to deliver fast impact but limit your flexibility in timing. After choosing the method, it's critical to set clear governance rules to avoid poor decisions that can destroy value. This includes repurchasing only when the stock is undervalued, maintaining enough liquidity to keep the business running smoothly, capping leverage to manageable levels, and ensuring buybacks don't compromise essential investments like research and development. Finally, clear communication with investors is key to reducing uncertainty. Outline the total buyback authorization, timing, how it fits alongside dividends and reinvestment, and whether the goal is just to offset dilution or actually reduce share count. Apple's approach is a great example of this transparency. It has turned buybacks into a predictable part of its financial story, giving investors confidence in the company's capital allocation strategy. Apple's decade-long buyback program is a prime example of buybacks done right. Over 10 years, Apple repurchased $704 billion of its own shares, dramatically reducing the total shares outstanding. This worked because Apple consistently generated strong operating cash flow, giving it the fuel to support buybacks without hurting its business. They also maintained disciplined execution, committing to this strategy year after year. Additionally, Apple used capital structure tools, like issuing bonds when needed, to fund these buybacks in a way that kept financial flexibility intact. Another important point is that buybacks are often part of a deliberate capital strategy, not just spending leftover cash. For instance, in 2025, Apple issued $4.5 billion in bonds to help repurchase shares while retiring maturing debt, showing this balance sheet leverage in action. Finally, buybacks are now a common corporate practice, especially in the US, after regulatory changes in the 1980s, where they're used as a tool to boost earnings per share, return cash to shareholders, and manage dilution. This broader acceptance shows how buybacks fit into modern corporate finance beyond just isolated cases like Apple. One of the main advantages of buying back your own stock is that it can increase earnings per share, or EPS, by reducing the number of shares outstanding, even if the company's net income stays the same. This makes per share metrics look stronger. Buybacks also offer more flexibility compared to dividends, which the market tends to view as ongoing commitments. With buybacks, a company can adjust the pace or pause repurchases without sending a negative signal. For shareholders, buybacks can often be more tax efficient, as they can shift returns more toward capital gains instead of dividend income, though this depends on tax rules and the investor's situation. Additionally, repurchasing shares can signal that management is confident the stock is undervalued which can build investor trust. Lastly, buybacks help offset the dilution caused by employee stock compensation, preserving value for existing shareholders. Overall, these factors make buybacks a useful tool in managing a company's capital and investor relations. When companies buy back their own stock at high valuations, they risk destroying long-term value because they might be overpaying for their shares. The funds used for repurchases could instead be invested in research and development, acquisitions, or workforce improvements, which could generate high returns. Using debt to finance buybacks adds risk too, especially if interest rates rise or the company's cash flow weakens. Apple's use of bonds to support its buyback program highlights how buybacks can be tied to leverage decisions. Additionally, repurchases can boost earnings per share even when overall profits remain flat, which might give a misleading impression of business strength. Lastly, large buybacks often attract political and public scrutiny, especially during times of layoffs, inflation, or when executive pay seems out of sync with company investments. These points form the main criticisms around buybacks and remind us there are trade-offs to consider. Apple's real advantage was not just buying back shares, but making capital return a disciplined long-term system. They generate huge cash flow, invest enough to keep their ecosystem strong, and use the extra cash to run one of the biggest share buyback programs in history. This shrinks the number of shares outstanding and boosts value per share on a massive scale. For other businesses, the lesson isn't to match Apple's size, but to adopt its mindset. Capital allocation is part of strategy. If you have strong cash flow, sensible valuation, and good governance, buying back your own shares can be a clean way to increase per share value and reward owners. But if done poorly, like buying at high prices, borrowing too much, or masking poor growth, it becomes harmful. In short, Apple didn't just sell products like iPhones, they also created a steadily improving value story through their stock itself, effectively making their shares a product in the market. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.